Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide. Here is Nathan Weaver.
Greetings and welcome to Kingdom's Wealth and Wisdom. I'm Nathan Weaver, founder and executive director of Petra Worldwide. Many high-earning professionals, corporate executives, physicians, software engineers, and consultants all share a common vision. They take their surplus cash generated by their demanding 9-to-5 activity and they deploy it into passive investments, primarily real estate. They look at their annual summary at the end of the year and they see a massive paper loss driven by depreciation, property taxes, and mortgage interest, and they get excited. They think, fantastic, this paper loss will pull me down into a lower tax bracket and wipe out my tax liability from my W-2. But tax season then arrives and they get a rude awakening. They understand that these losses are trapped. They cannot be applied to their active wage. This is due to a structural barrier known as passive activity loss rules. In 1986, Congress built a legal firewall to stop high earners from using paper investment losses to shelter their active income. Today, we're going to break down that firewall and more importantly, provide a roadmap of a rare operational escape hatch that you can use to legally and legitimately breach through that firewall and lower that W-2 income. To navigate this landscape, you must understand that the IRS separates your income into two distinct buckets. The first bucket is the active income bucket. That includes your W-2 salary, your bonuses, and your active business profits. The second bucket is passive income. This includes income from rental properties or businesses where you are a silent partner. The golden rule of IRS Code Section 469 is simple. Passive losses can only be used to offset passive income. If you have a duplex that generates a $30,000 tax loss due to a cost segregation study and depreciation, but you have zero other passive investments, that $30,000 cannot touch your $300,000 corporate salary. Instead, it becomes a suspended loss. It is frozen on Form 8582, carried forward indefinitely into the future years, and remains trapped until you either generate a passive profit or completely sell the property to an unrelated party.
Pastors and financial leaders, do you need expert accounting or tax help? Do you have payroll or 1099 questions? Do you need a ministry expert to help you acquire real estate for your next project? If the answer is yes, yes, and yes, visit petraworldwide.org. Petra Worldwide has been strengthening ministries to transform humanity since 2007. Visit petraworldwide.org or call 855-481-9095.
So there are two primary escape hatches in this passive loss scenario. The first one is the $25,000 active allowance. If you actively participate in your rental real estate, meaning you own at least 10% of the property and you make meaningful management decisions like approving tenants, setting up leases, signing off on major repairs, the IRS will let you include up to $25,000 of that passive loss against your W-2 income. The second escape hatch has a few more qualifying rules, but this strategy is to achieve status as a real estate professional. If you are able to achieve a status as a real estate professional, which means you spend more than 750 hours a year in real property transactions and business, and that real estate work accounts for more than 50% of your total working hours, this turns passive real estate into active real estate. Now you can apply it to your W-2 wages.
Listen every day at 4 p.m. for Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide, strengthening ministries to transform humanity. On the web at petraworldwide.org.